This is the current federal tax developments for the week of July the 14th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Metzollers coming this week again from here in Phoenix, where we got up to 118 this week, so we're on the nice warm side. I'm going to take a look at a few developments that took place in taxes this week, beginning with, whoops, went a little too far there if you're watching the video, went a little too far there. The recent development on the Johnson Amendment, the potential concession by the IRS in a court case. And we'll talk a little bit about that, trying to stay away from the political side of the discussion, and we're going to primarily talk about what exactly is in the proposed judgment, consent judgment that would be entered, and what it would impact as it stands. We're also going to take a look at a issue of a client who believed they had a settlement. They believed they had caught the IRS basically in a foul-up. For their settlement, they were going to take this settlement, or at least the attorney apparently believed he had noticed a foul-up. And the court's going to take a look at whether or not they could take advantage of that foul-up and force the IRS to continue down this path. We'll discover the answer is no. And there's an interesting Bipartisan Budget Act partnership exam problem that the attorney didn't take into account in this particular case. So we'll talk a bit about that, because that one, even if you don't deal with, this one deals with conservation easements. Even though if you don't deal with that at all, if you deal with partnerships, this particular problem that arose is one I could easily see happening in a partnership. So keep that in mind. We'll talk also about a problem a taxpayer had with notifying the IRS of her address change, last known address issues. And so we'll discuss that and, what she did, what she probably should have done, and various missteps along the way. And finally, we actually got a new tax bill. And no, I'm not talking about, the One Big Beautiful Bill Act. No, we're not going to go through that in detail. This week, I gave a continuing education course on the Act. And, we had about a 3-hour course and still had like 40 minutes of questions after the course ended going through. So yeah, it's a big thing. And so we're not going to cover it in detail here. We'll cover developments as they occur, as IRS gives guidance and that going forward. But the actual full bill, yeah, just don't see that realistically we could cover it here. But we did get, though, another bill, at least it's on the president's desk for signature. So we'll talk about the Filing Relief for Natural Disasters Act, what it is, why it matters, and what exactly goes on with it. But with that, let's start with the developments in interpreting the Johnson Amendment to 501c3 in tax-exempt status litigation. And this week, we had a proposed consent judgment offered between the IRS and the litigant in the case of National Religious Broadcasters et al. Versus Billy Long from the U.S. District Court, the Eastern District of Texas. And this was proposed to the court on July the 7th. Now, some background on what we're talking about here. This particular litigation involved a claim that the Johnson Amendment, which imposes, as we'll discuss, certain restrictions on political activities of 501c3 organizations, especially as regards to the elections themselves, that was in conflict, at least if interpreted in one way, it would be in conflict with First Amendment requirements, both on freedom of speech and the separation of church and state. Basically in essence, favoring certain religions over another. And so we got into that. And the key question we're going to do here, if we boil it down to very basics, is going to go, is it okay for a church to have somebody from the pulpit, let's say the minister from the pulpit, specifically mention and effectively endorse a political candidate? Or does that risk the church's basically tax-exempt status? So the donations to the church would no longer be deductible as 501c3 organization, and the church itself would basically now owe taxes on its earnings. So, but both of those are things that would be kind of a problem for a church. So we'll talk a bit about this. Now, this is a proposed consent judgment. It is currently under consideration by the court. It has not yet been, as far as I've heard, actually accepted by the court as, as they're to enter it as the final judgment. This proposed judgment, which again has been proposed by both parties, would address the interpretation of the Johnson Amendment as it applies to churches and their tax-exempt status. And while it's not binding, right, and it's not yet binding on anybody until the court actually would enter the judgment, it does offer some insight into basically how the IRS now is thinking about religious organizations' political speech and its potential impact on their tax-exempt status. So it is important if you're advising organizations, you may want to, and you have an organization that hears about this and they now want to, in their view, take advantage of this. Yeah, you need to understand the limits here. Where how far out does it go? And again, since we're talking about qualification, I would certainly, in essence say, if we're going to do something this big, we probably do want to, sit down with counsel that's up to speed on 501c3 issues, and review, the ultimate judgment, and make some decisions based on that. But we'll talk a little bit about this. But if you're advising tax-exempt orgs, yeah, especially churches we're looking at here, religious groups, then yes, it is a big deal. Now, Internal Revenue Code Section 501A establishes a tax exemption for organizations described in subsection C or D of 501, as well as Section 401A, the qualified plan areas. And of course, we're dealing here with 501C right now. Now, 501c3 has details entities organized and operate exclusively for religious, charitable, scientific, literary, or educational purposes, among others. And a fundamental requirement to be exempt from tax under 501c3 is that no part of the net earnings can inure to the benefit of any private shareholder or individual, even if not an equity holder of any sort. And, the question is, of course, well, does an endorsement from the pulpit, would that violate this? And that wasn't clear, but in the 50s, if I remember my history right on this, we had an amendment to 501c3 called the Johnson Amendment. And it basically imposed significant restrictions by clarifying that as part of that private inurement, if you're a 501c3, no substantial part of the activities of the organization can be carrying on propaganda or otherwise attempting to influence legislation except as provided under subsection 501H. And yeah, there are allowed levels of activity there. And which does not participate in or intervene in, including the publishing or distributing of statements, any political campaign on behalf of or in opposition to any candidate for public office. Now, obviously, we are looking at the second part of that one to a large extent. In essence, is this the political campaign problem when we have this particular, an election in front of it? Is it appropriate, for a minister to basically, specifically endorse based on, religious-based background, say you should vote for X, rather than Y, do they have the right to say that from the, and we're going to say from the pulpit right now, that's the most dramatic way, and we'll talk about what this settlement would suggest when we're there. Now, this lawsuit was initiated a little bit less than a year ago on August the 28th of 2024. It is the plaintiff is National Religious Broadcasters, which is Intercessors for America, Sand Springs Church, and First Baptist Church, Wascom. So these churches, etc., are involved. The defendant, Billy Long, became the defendant because he has now been confirmed as commissioner. That's what you get when you get confirmed. You get added as defendant in all of these government cases. And the IRS is also a defendant. Now, according to the plaintiffs, the Johnson Amendment, both on its face and as applied. So on its face, meaning, basically it just automatically would be, a problem just as written. But then as it would apply to churches, it's also a problem. It would deal with the First Amendment rights. It would violate essentially both the freedom of speech and the free exercise of religion. It would also violate Fifth Amendment rights, the due process of law, and equal protection under law, and the Religious Freedom Restoration Act. Now, what they asked for was declaration the Johnson Amendment unconstitutionally prohibits political speech by 501c3 organizations and to prevent its enforcement, insofar as it restricts such speech. Now, that's what they asked for, not necessarily exactly what this agreement would give them, but we'll talk about what it gives them. What the proposed judgment outlines a very specific interpretation, particularly concerning houses of worship. Both sides stipulate in this proposed consent judgment that when a house of worship in good faith speaks to its congregation, right, a limitation there, through its customary channels of communication on matters of faith in connection with religious services, concerning electoral politics viewed through the lens of religious faith, it neither participates nor intervenes in a political campaign within the ordinary meaning of those words. Long-winded way of saying, as long as it's going to their, basically, those who are attending the religious services, who are there, it is through normal channels. You're not buying nationwide, ads on, what in the world is it, ESPN every day, right? Doing that's not the normal channels you communicate with your, with your faithful through, shall we say. Of course, it does open up an interesting interpretation for various groups, that do maybe do that sort of thing, that advertise and, communicate religious religious items through there. So again, you'd have to see how this expands out. That's where things will get a lot more interesting if this is adopted by the court. Okay. Now, the key definitions: to participate in a political campaign is limited to mean to take part in it. And intervene means to interfere with the outcome of it. Okay? And the parties agree that both bona fide communications internal to a house of worship, or that bona fide internal to a house of worship between a house of worship and its congregation in connection with religious services do neither of those things. So, right? Now, they claim here that this aligns with the IRS's general practice of not actually going out and enforcing the Johnson Amendment against, religious groups for any speech concerning electoral politics in the context of worship services, despite they do receive a lot of complaints about that. And to be totally fair, they receive complaints from people on both sides of the aisle because there are politically active congregations, that have wildly different views. So we do see that. Basically, the IRS has generally not intervened there. They look at it more on the standpoint of outside of the actual worship service. Do you do those things? So worship service, presumably communications through things like, maybe newsletters published by the church every week, or email blasts they send out every week. Those sorts of things would apparently be covered, I'm going to think, by this. But again, if you're going to be following this, and your first thing is wait to see how the dust settles. But if you're going to, quote, indirectly rely on this, I would definitely be very careful. Outside of the pulpit, we need to have a nice long discussion about how this is going to go. Now, the proposed judgment emphasizes that the interpretation is supported by the doctrine of constitutional avoidance. Applying the Johnson Amendment to internal communications could create serious tensions with the First Amendment's Establishment Clause. And the claim that's made here is the problem would be it could be seen as favoring religions that do not engage in electoral politics over those that do, based on their internal speech of their congregations, potentially violating the Establishment Clause prohibition against officially preferring one religious denomination over another. You may remember in that basically state unemployment tax case a couple weeks ago from Wisconsin, that was how, the Supreme Court resolved the issue of, this particular group, even though it was being run by the Catholic diocese, because the diocese, as a matter of faith, did not believe in basically tainting the good works by basically using that as an advertising opportunity to recruit new members, to recruit new members to the church, to basically, give them a nice hard sell, that violated the Establishment Clause. Therefore, they were preferring religions that did do the hard sell. If they did something and did the hard sell, that they could be exempt under Wisconsin's interpretation of the rules. But the Catholic diocese, sorry, you're not doing the hard sell, so we're going to force you to pay, to be under the unemployment clause. So we did have a recent Supreme Court that did look at the Establishment Clause in the context of preferring one religion over another, right? And therefore favoring one. Now, if approved by the court, this is important. The court has to review this. The mere fact that the two parties agreed to it, remember, as a judgment, it does have influence. It can be referred to in other cases, right? And issues of that sort. The court is not really allowed to enter a judgment that just blatantly misstates the law, right? So it's not that they just really don't. Now, they realize neither party's challenging. So it's more along the lines of my understanding that the court's just going to see if this is a reasonable view and not really worry too much about whether or not, had it gone all the way to trial, that this is what we would have come out with, either one way or the other. Seems unlikely if the court was just writing, its opinion after it heard the case, that it would come out exactly like this judgment. But so it's being offered. But it would recognize a formal acknowledgement of interpretation that, for practical matters, has largely guided the IRS enforcement practice regarding religious organizations. So, for tax pros, it means an enforced understanding that churches and other houses of worship generally have latitude to address electoral items through the lens of religious faith in their internal communication with congregations during religious services, would not jeopardize their 501c3 status. Again, the question becomes how far you can take this. I would say, presuming you want to do it. Remember, technically, this is only a case between the IRS and these churches and the broadcast organization. It's not a case technically involving your local congregation. Yep, they weren't part of it. Well, maybe if they were, then fine, they're part of this, but otherwise it doesn't. But it does suggest that such preaching would not cause you the problem. Again, how far away from that you can stray, whole different question. Because again, we don't know that this would have been the result with a full-blown trial. We just know it's what we've got for the moment. Now, key limitations still would remain even with this agreement. The communications must be in good faith, aimed at its congregation, right? This doesn't open the door, to the church, going out there and going after others for this, right? It's got to be through its customary channels of communication. Opening up and doing something brand new, yeah, that's, again, especially when that new channel only talks about this political issue or only runs during the election period, that's probably a step too far. So it doesn't seem to be covered by this. It does have to be on matters of faith. So you got to make sure that, you're not going to endorse somebody without tying it back to the, to basically to the religious beliefs of the congregation or of the denomination or of the church. You've got to tie it back, to this. And it must be in connection with religious services. So kind of an extended version, kind of the opposite of the Wisconsin deal, right? We got to be doing the religious service bit here. So presumably under this agreement, assuming that this is what the IRS were to follow for everybody else, they couldn't have political endorsements based on their faith in those, in the Catholic Church's, daycare center or the things they were running in Wisconsin. Presumably because, of course, according to their faith, that wasn't the place to do it. So, it's not part of their religious services, and it's not outreach to the congregation because that's specifically why they weren't doing it. So, again, watch for these interesting things. Now, it does not open the door to churches or other organizations to engage in broader activities. This includes endorsing candidates outside of the Congress, right? Basically, Congressman Smith can't say, I'm endorsed by, the ABC congregation, right? Allowing that sort of endorsement a problem. They can't donate money to campaigns, right? They can't engage in public political advertising beyond their internal faith-based communications. So all of those are essentially on the, nope, this per the agreement is too far. Uh, Also, the proposed injunctive relief specifically applies only to the plaintiff churches and their stuff. So that's also a potential problem, which you need to talk with legal counsel about in this area. And as the proposed consent judgment, it's not legally binding even on them. It awaits the court's approval and entry. So the court needs to, everybody needs to monitor this decision if you're in the not-for-profit advising churches. But obviously, it is something you need to be aware of. Now, if this is entered, the indirect effort would initially be limited to those plaintiffs, but the interpretation itself is the best reading of the Johnson Amendment. It probably will influence future IRS guidance or enforcement. It's certainly because it is something that the IRS signed off on. I'm sure it would probably influence other judges to say, well, wait, in this litigation, you said this, right? Now you're coming back here and saying, no, that's wrong. Why? In essence. So are you telling me those churches got a better deal than anybody else? That'd be kind of the back door we do it. And basically for all 501c3 organizations, including those that are not religious, the general prohibition against participating in or intervening in political campaigns remains in full force. And it's probably difficult for non-religious, non-church organizations because remember, a lot of this is based on, ultimately, this is an establishment clause decision. And establishment clauses look at establishing an official church and how that's been interpreted. So that probably means that other 501c3 organizations don't really get anything out of this one, right? Because it's not really how it goes. The distinction between advocacy and issues, including via lobbying within limits under 501H and prohibited campaign intervention, is still critical for maintaining tax-exempt status. Again, if you start testing the limits here, you are putting the organization's exempt status at risk, or the churches, because really, remember, this really only covers churches, so you have to understand that. Churches, synagogues, etc., similar houses of worship would be covered by this. So, yeah, it is one of those things to be careful of. Again, it's politically charged, and that's always a difficult thing to talk about with your clients. We have to make sure that we separate out our political beliefs from what we're telling the client. Whether we think this is a good idea, a bad idea, whether we think that churches should have unlimited ability to do political, work, or whether we think they should be strictly cut down to zero. When we're serving as advisors, we have got to be able to divorce ourselves from those concepts and come back and, tell our client what exactly is, how this applies to them. Now, so somebody doesn't go after and misinterpret what I just said, I am not saying you have to serve an organization. If you decide just on your views you will not serve, a charity that does X, yeah, you don't have to accept the client. But if you accept the client, you have to give them the proper advice. That's inherent in having accepted the engagement. You can't accept the engagement and then edit your advice, to suit your views. And so that's why it's got to be very careful to make sure that you don't let your views influence the advice you give, either saying you can or you can't do something. Okay, next up. We got a group here that thought they actually caught the IRS making a major error in proposing a settlement. This is the case of Arden Row Assets, LLC versus Commissioner, Tax Court Remand Decision 2025-71 on July 8th. And this involves a conservation easement. Now, it is not a syndicated one. We will get to that. What's there, which means it was really just a private small group was involved. And the problem was this organization that was involved in this was also involved in syndicated easements. So Yeah, there's a big mess here. But this involves the proposed settlement that the IRS offered to the partnership, and whether after the partnership said, "Oh yeah, we think that's a good idea," was the IRS bound? And we'll discover that there's a lot of reasons why, the partnership ended up not winning this case. So this is talking about, and these are some base rules on settlement discussions, right? Particularly in the context of conservation easements, syndicated or non-syndicated, actually is the case here. It does underscore a key issue. Settlement agreements are contracts. And so the legal side of this, again, is that contract law principles are applied to these settlement agreements, right? So it's basically a contract law, not basically a federal statutory interpretation here. And so that means, as the court emphasizes here, that we're going to have as important, there was a clear mutual assent to the agreement, that they adhered directly to prescribed methods to accept the agreement. The party that offered the agreement, there was a prescribed method of how it should be accepted. And third, really important here, this is statutory, and this is an interesting problem that this one points out. See if you're not really into the first two things here. You probably need to be interested in the third if you do partnerships, was that you must have proper authority under the Bipartisan Budget Act audit rules to do anything on behalf of the partnership. And that third point is the one I think you got to be really, if you take nothing else away from this one, you got to be aware of the third one, because I can easily see an advisor, which appears to have happened in this case, an advisor conveniently ignoring that and just, sending in acceptance letters without necessarily worrying about who had the right to actually accept it. So this is Arden Row Assets, LLC. It was a partnership federal tax services, and it was subject to the Bipartisan Budget Act procedures. Okay, it claimed a charitable contribution deduction, non-cash, of just over $57 million for a conservation easement it donated in 2018. Now, the IRS disallowed the deduction in its entirety. Arden Row's partnership representative on the return was Natural Aggregates Partners, LLC, and Matthew S. Kaynard was listed as the designated individual. Remember, under the Bipartisan Budget Act, the partnership designates a partnership representative, and if that partnership representative is an entity, then we have to have a designated individual. So Matthew Kaynard was the only person that could essentially do anything directly with the IRS to bind the partnership in regard to this exam. Right? So keep that in mind. Matthew Kaynard is the key person in regards with this. The principals, Mr. Ornstein and Schuler, promoted and implemented numerous conservation easements transactions, some syndicated, some not. So we were in that background. So there was a bunch of these. Now, in 2020, the IRS announced a settlement initiative for syndicated conservation easement cases, generally disallowing the easement and allowing investor out-of-pocket costs and reducing penalties. Now, Category 1 partners of those syndicated conservation easements, those who organized, marketed, or implemented transactions, like Ornstein and Schuler. Now, this one wasn't, but they had ones that were not eligible for out-of-pocket cost deductions for for what they put into the partnership under that settlement agreement. Now, what the issue was, a key development was the tax court's opinion in Lake Point Land 2 LLC versus Commissioner, where the IRS supervisory approval form was found backdated, leading to sanctions and a settlement that allowed investor out-of-pocket costs and exceeding penalties. That fouled up a lot of this whole area with the conservation easements. So in October 2023, after penalties were conceded in Arden Row due to a Section 6751, the supervisory approval non-compliance, the National Office decided to propose settlements allowing deductions for investor out-of-pocket costs, including for these two. Now, the IRS used a template letter that was intended for syndicate easement cases. Okay. Now, this one isn't really one, but remember, because others they had were, so they offered this apparently broadly, instructing the attorneys at the IRS to add amounts from Schedule M2 capital contributed cash line of the investment tier partnership to the amount, what they'd offer settlement. On October 24th of 2023, the IRS sent a proposal to the partnership's counsel that incorrectly described the case as involving a syndicated conservation easement transaction. Based on that, which was a misunderstanding, right, or basically an error, pretty clear, they offered to disallow the $57 million charitable contribution deduction entirely, but allow another deduction of $24,586,019, stating this approximated out-of-pocket cost and was determined by reference of National Aggregates Schedule M2. And they would concede all penalties. And finally, the settlement required the respondent and petitioner agree to resolve this case by filing a decision document. That kind of thing we just talked about with the Johnson Amendment, that they had to agree to basically to both sign off on a proposed decision document that would be submitted to the tax court. Now, counsel for the partnership recognized immediately that the $24,586,319 figure was incorrect for Arden Row. It was a non-syndicated transaction, had no outside investors. Problem one. Number two, they knew, remember, National Aggregates contributions to all 8 entities it owned. That was what went into that partnership. Only a very small amount went into this partnership that represented the two parties' real contribution, right? Now, Mr. Schuler, who authorized the acceptance, remember, that wasn't the name of the tax matters part, not tax matters part, we don't have anymore, but of the party's representative and the designated individual, that was the designated individual, but Mr. Schuler was the one who authorized the acceptance. He was not informed the amount was meant to approximate out-of-pocket investment, and Mr. Schuler knew. I mean, he'd have known instantly that $24,586,019 was not the out-of-pocket cost for investing in this sub-partnership, that was wildly overstated, right? So, he was never told that's where the number came from and why it was. And he's, of course, the one that accepted it. Now, these are all going to be problems. Now, did the attorney keep that from him because he was afraid he might squawk at it? He didn't want to tell him the service had made it? I don't know why. But in any event, per the testimony at the case, he was not informed about this, but he clearly knew, he would have known the minute he was told that that wasn't our out-of-pocket cost. That was way above. Okay. Mr. Welty, who was the counsel, did not consult with Mr. Ornstein, the other partner, or Kaynard. Kaynard was that designated individual for Arden Row's partnership representative before sending the acceptance letter signed by the other partner. Okay. On November 7th, the partnership sent an acceptance letter stated agreement to the sum proposal and determined the other deduction by reference to the investment tier partnership's Schedule M2. Right, the wrong one, but okay. On December 23rd, the IRS recognized that, hey, we really fouled up in a big way. That number is way too high. They proposed changing the deduction to $110,900, which was the actual M2 capital contributions in the partnership under exam, not the partnership that owned it. Right? So, you got to follow that, right? It was the partnerships whose return was under exam. That's the real number. Now, suddenly the partnership refused, leading to disputes. And they subsequently filed joint status reports saying why they had no basis for settlement. So now they're going to try to force the IRS to do this. Right? Now, the tax court said, look, a settlement is a contract governed by the general principles of contract law. And to the extent that it's important, there may be IRC provisions that impact it. Key aspect of a contract is a mutual assent. A meeting of the minds to essential terms is critical for contract formation. There's an offer and there's an acceptance. The offerer, which was the IRS in this case, retains the power to prescribe the method of acceptance. If a settlement is conditioned on execution of additional document, the decision document in this case, its execution controls whether a binding agreement was reached. And mutual assent requires objective manifestation. Oh, I love that term. There's no mutual assent if the parties attach materially different meanings to their manifestations, and neither party knows the meaning attached by the other. This is where failing to inform the partner is going to be a problem, right? Yeah, we're going to say. Remember, the person that signed to accept, in addition to not being the designated individual, was not aware of what the IRS meant by out-of-pocket costs. He wasn't aware it was giving out-of-pocket costs. That was a problem. The mutual mistake doctrine applies where a contract exists, but parties made the same erroneous assumption. Under the Bipartisan Budget Act rules, too, the partnership representative, and when we have an entity, the designated individual, then, by extension, has the sole authority to act on behalf of the partnership and to bind the partnership and its partners. The Bipartisan Budget Act does not expressly allow an individual partner, no matter how much of the partnership they own, no matter what their standing is, it doesn't matter, right, to enter into a separate settlement agreement that converts the partnership items to non-partnership items. They can't really do that. They can't move it on to out of the BBA. So they're not allowed to do that, which would be the only way to save this at this point. And the petitioner, basically the taxpayer, the partnership, bore the burden to prove there was a binding settlement agreement. The court denied it, denied the fact, motion to enforce a settlement, citing 3 independent grounds. Any one of these grounds by themselves would have said, sorry, it can't be enforced. Number 1, the prescribed method of acceptance was not met. The settlement proposal clearly stated that resolution required filing a decision document which the court deemed a material item, not merely a ministerial act. Here's the key. A ministerial act is considered just a formality. It was a mere formality. What the court considered here was this was a material item. This was by necessity going to be subject to negotiation on exactly the terms. While there was a broad outline of an idea in the proposal, the actual detailed settlement would be there. And, now the question becomes, does settlement agreement merely say, that, hey, this is giving them the amount they invested, in the partnership, and and that amount was, you could see it on the return, that's, in essence, that had to be something that was actually signed off on. Was it going to say that? Was it just going to say 24 million? Yeah, we don't know how you get there, right? Now we're going to get it. It certainly was never done. The partnership's subsequent actions, filing a joint status report saying no basis for settlement and proposing trial dates, contradicted the claim that a binding agreement had been reached via letters. In essence, yeah, they kind of safeguarded because, hey, we got to go to trial if this doesn't work. It also said, separate from the fact that that agreement was never drafted and filed, number 2, there was a lack of mutual assent. The parties had materially different meanings to the other deduction amount. Clearly, the IRS, by what they said, when they sent out the agreement, they meant for it to be a deduction for investor out-of-pocket costs, approximately. Now, Mr. Schuler, the partner, remember, the attorney knows that's an error. But the attorney, per, what the court ruled here, evidence said, didn't tell Mr. Schuler that that's what the IRS meant. So he understood they had just agreed to give him a fixed deduction, like a compromised number. Yeah, it's a weird number, but, somehow compromised the number. And, so they would get a significant portion of what they were going to get otherwise, what they'd claim, but not the whole thing. So it looks kind of like just kind of an agreement to settle. We're just not going to challenge. Crucially, neither party knew the meaning attached by the other. The IRS was not aware that Mr. Schuler just believed this was a compromise settlement. There's just compromise on the amount. And Mr. Schuler didn't realize the IRS meant it to be an out-of-pocket cost settlement. There was no meeting of the minds. They didn't agree to the same terms. the attorneys were the only party that knew, essentially, the parties knew that the attorneys knew this was a mistake on the part of the IRS, knew what the IRS thought, but never informed the party that actually executed the agreement. That was a problem. Right? Finally, and this is a big gotcha, this one can cause us all kinds of other issues. If you have a BBA partnership rule, remember, the partnership representative or its designated individual had to bind the partnership. Now, I realize they're all involved with this, but the problem was Mr. Kaynard was a designated individual. He was a party that should have done this. He was never briefed on this. He did not sign the agreement. There's no evidence Mr. Kaynard approved or was consulted about it. And Mr. Schuler, who authorized acceptance, lacked authority to bind Aspen Rowe. So he wasn't like acting as an agent of Mr. Kaynard. Mr. Kaynard was the one who had to approve this agreement. So Ina didn't have the first two problems. The wrong person signed it. It's just like he had Mr. Schuler had, as a practical matter, to bind the IRS as much authority as a random person walking down the street in front of the attorney's office would have. So same problem. The BBA does not permit individual partners to settle partnership-related items separately. Right now, we can argue about whether or not the partnership probably was not eligible to elect out a BBA. But it is an issue. If you don't elect out a BBA, you got to be very careful about making sure the partnership representative, if you use an entity, the designated individual, signs off on any agreement. That's how it's binding. So, key things, make sure you scrutinize any terms of an offer, review explicit terms of some an offer, especially any conditions to acceptance, such as the requirement to file decision documents, and never assume such conditions are merely ministerial. Right? You got be careful. You got to make sure the IRS is bound to execute, or there's a proposed settlement document there that will be filed. The fact you left that to be done, yeah, that's the problem. There was never a binding. If you just agree to this settlement document, basically to this decision document, right? And you agree, we will, if you accept this, we represent, we will file this document. You need to consent to it, we'll file the document. That's what you said. That would be a little different. Not really what happened here. Make sure both parties have a clear shared understanding of all terms, particularly the nature and amount of any deductions or liabilities. Remember, if you're going to get a settlement that the IRS can't get out of, you got to make sure that you are not relying upon, what's essentially a mistake in the offer for a settlement. This is a little different than a mistake in, at least technically different than a mistake in, let's say, if the IRS actually has issued the assessment. And that'll be a different issue, at that point. But at this point, they're just offering to agree. So you got to make sure if your description is identified, clarified immediately. Subjective intent is less important than objectively being able to show what they believe, of that issue. So make sure you've got it there. And really, really watch the BBA requirements for who can actually approve things like this. Ensure the party's representative or designated individual is the sole party authorizing settlement. Individual partners, I don't care how important they are to the partnership, if they are not the partnership representative, they are not the designated individual of the partnership representative, they can't sign it off. That was a key, that was a huge problem here. Maintain clear documentation of all communication and ensure consistent understanding. The failure of, TPC, the, counsel, to fully appraise Mr. Schuler of the IRS basis for deduction, despite being aware of the mistake, was a critical factor in showing there wasn't a mutual meeting of the minds. In essence, both parties, in essence, counsel knew the IRS made a mistake, kept quiet about that, and also didn't tell his client, or at least the one that signed off on the agreement, that there was a mistake. or inform him of what the settlement was supposed to be, to know, exactly what was there. Because again, the other question was if the court simply had just said, okay, we'll bind him, but it's going to be the invested cost because you should have known that. Well, yeah, Mr. Welty, not Mr. Welty, but in essence, Mr. Schuler may very well have said, no, 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 we're not going to settle for just 110,000. So that's kind of the problem. Again, contract law principles are big here. Make sure you're aware of that when we have settlements. Okay, split dollar life insurance, McGowan versus United States. This is Peter McGowan, Michelle McGowan, Peter E. McGowan, DDS, Inc. versus United States from the Sixth Circuit on July the 9th, case number 243228. This involves the dentist and the life insurance policy and the split dollar arrangement. Okay, this Sixth Circuit gives us some insights in the applicability of the split dollar insurance regulations and deductibility of related employer contributions. Right. The case largely affirms the district court award of summary judgment to the IRS. It largely upholds their assessments against Dr. McGowan and his dental practice, which was Peter E. McGowan, DDS, referred to in the agreement or in this, in the case as the company. So Dr. McGowan and the company. Now, Dr. McGowan is a Toledo area dentist, and he was the sole owner of the C Corporation, Peter E. McGowan, DDS, Inc. So we got Dr. McGowan and his C Corp he controls sitting there in Toledo. Now, the plan was a sophisticated life insurance arrangement from 2011 to 2015. It was designed to be a, quote, tax-efficient alternative to an existing whole life policy to minimize the tax burdens for both Mr. McGowan and the company. Now, it operated through a benefits trust arrangement that established two subtrusts. There was the Death Benefit Trust. That trust purchased and owned a whole life insurance policy on Dr. McGowan. The company contributed $37,222 to DBT, the Death Benefit Trust, to cover the policy's base premium. The Restricted Property Trust, the RPT, received up to $12,778 annually from the company, which it then transferred to the Death Benefit Trust. The funds were invested as paid-up additions, I'll get that right, to increase the policy's cash value and death benefit. In return, the Death Benefit Trust granted RBP a security interest in the policy's cash value, a split dollar arrangement. Right, so basically it's traditional split dollar insurance, the idea being there. There's a Death Benefit Trust, and we have the other parts of that. Okay. Now, Aligned Partners Trust Company served as a trustee, but its independence was really limited because the company could immediately revoke the trustee at any time and for any reason. Now, the other thing the panel pointed out was that Dr. McGowan primarily sought personal financial benefits to the company. The only real benefit to the company, they're going to claim some others, but which the court's going to reject, he said, but the only real benefit that existed for the company was they got deductible payments for putting this money into the program, right? So they were able to essentially shelter $50,000 a year by putting the money away, into this trust where it would magically disappear for a couple of years. Now, there were 3 end scenarios within its 5-year increments. If Dr. McGowan died, the Death Benefit Trust paid a death benefit to Dr. McGowan's designated beneficiary, his wife. If the company chose not to renew the policy after 5 years, the policy would terminate and Dr. McGowan would take direct ownership of the policy. And if the company failed to contribute the base premium, then the Death Benefit Trust would surrender the policy, transfer the cash to the, to the RPT, right? And the RPT would then donate the proceeds to a charity chosen by Dr. McGowan, which would be the Toledo Zoo. Okay. Now, during the plan's operation, the tax position was Dr. McGowan did not report the value of the death benefit or accumulated cash value as taxable income. Under the split dollar rules, generally he should have picked that up, right? He did report the annual $12,778 contributions to the revocable premium trust as income. That's not disputed by either side. Now, the company claimed annual deductions of $50,000 for its total contributions to the subtrust. So again, basically then, Dr. McGowan got, as you may recall, when we go back to the contributions, they essentially, that 37,222 going in every year, yeah, they were, that was in essence what was being deferred. In all of this, as the company would claim a deduction for 50, Dr. McGowan would report 12,778. Okay. In 2016, Dr. McGowan took direct ownership policy, and he reported 115,227 as taxable income, the remaining cash values. Now, again, the IRS here is going from 2011 to 2015. They concluded that McGowan should have recognized the policy's accumulating cash value as taxable income every year, and the company should not have deducted its contributions to the DBT. There was no business purpose, right? The IRS assessed over $100,000 in additional taxes and penalties for 2014 and 2015. So in essence, yeah, effectively, he picked up income, but the problem was, yeah, if this is done right and we disallow the corporate deductions, we're looking at significantly more tax than Dr. McGowan paid. Now, the IRS position based on Treasury Regulation 1.61-22, which is the regulation that governs split dollar arrangements. And it specifically looked at the compensatory split dollar arrangements under Regulation 1.61-22B2I. That regulation applies to arrangements between an owner and a non-owner of a life insurance contract entered in connection with performance of services, the taxpayers conceded it was, where the employer pays the premiums and taxpayer concedes all the premiums were paid by the by the practice, by the company, and where the employee designates a death beneficiary who has an interest in the policy cash value. Now, the taxpayer is going to dispute the owner and non-owner and whether they actually had the power to designate the benefits. And it's where they have an interest in the cash value. Now, what the taxpayer disputed about the owner and non-owner, they said, no, the death benefit trust was the owner of the policy. That made the company a non-owner. That was the purpose of the death benefit trust, to try to establish that this was not a contract between the owner and the non-owner of a life insurance contract for services, but a contract between a non-owner, right, and a non-owner of the life insurance contract. Yeah, that kind of cute structure immediately should send up a bunch of red flags. I mean, is a court really going to ignore that, and go and ignore a substance over form argument here? Or are they going, or even better, are they just going to look like mad for a reason to say, no, the company really was the owner of the policy? But that's kind of the fight. And as I said, not surprisingly, the court rejected the argument. The Treasury Regulation 1.61-22C1 specifically treats the employee as an owner if the policy is held by a welfare benefit trust, as defined by Section 419E1 of the Internal Revenue Code. The taxpayer had conceded in the district court case that the DBT was such a trust. And the court emphasized the principle of substance over form, viewing the subtrust as economically meaningless interposition that didn't defeat the company's ownership right. It was simply there for no reason except to make the company a non-owner. And they said, especially given that the company had the unfettered right to fire the trustee at will and replace it with whomever they wanted. They essentially had control over the policy, right? I mean, they were there. They essentially could run it. The court also confirmed the employee benefit condition was met because McGowan, as the employee, designated his wife as the as the beneficiary of the death benefit. The charity's interest was only in the cash value, not a death benefit. So it was, it's basically, yes, he had to die for her to get it, but the only death benefit in that whole thing was if he died. Everything else was based on other reasons, like the charity was a cash value. The taxpayer said he didn't underestimate his gross income because he lacked current assets, the policy's cash value before 2016. And he claimed a substantial risk of forfeiture due to the potential forced donation to the charity. Current access, the court said no. under Reg 1.61-22D4II, that current access explicitly includes a current or future right to a portion of the policy's cash value. And the court said Dr. McGowan possessed several such rights. He had the right to receive the policy upon company non-renewal. He had the right to designate the death benefit beneficiary, and he had the right to designate the charities to receive the cash value. He controlled everything, right? And a substantial risk of forfeiture concept, which comes from Section 83A1 of the Internal Revenue Code, is an apple here, as Section 83A2 specifically redirects taxation of life insurance protection under a split dollar arrangement to the split dollar regulations. Risk of forfeiture didn't matter. Now, what reading between the lines, what I'm seeing here is likely there was a marketing arrangement. Usually there is. These are marketed, and it had a nice, fancy, and apparently, some sort of document attached about the reasons why this thing worked. That certainly sounded like it had a solid base, but if you actually followed through on it, you quickly discover that the base isn't there. Yeah, that unfortunately, almost every one of these sorts of structures, where you see them heavily marketed, you got to be very, very, very careful about that supposed that, oh, we've got this analysis, it proves exactly why we can do it. Really need to have independent counsel that is not involved with the arrangement, actually review it. Because most often these types of structures are marketed. They're marketed as a way to sell a product, in this case, probably the insurance policy. And so basically, and quite often they come with an opinion given to the, it's not really even an opinion, but some sort of letter from counsel or someone, or maybe even another tax pro that is given to the marketer. Remember, those don't protect you, right? That goes back to neonatology decision that, a letter that is written, they're basically advice you receive from a party that only gets paid if you do the transaction, right? You're not paying for advice, you're paying them for the transaction, and they're throwing in the advice for free. You might have a reason to believe that advice might be biased, just might be. So you need independent review, right? The court also said Mr. McGowan derived an intrinsic value from selecting Toledo Zoo as a potential beneficiary, making that charitable donation itself a current or future right. So you couldn't say, the charity, which I'm sure that was the reason charity was stuck in there. Look, this third party is going to get it. Yeah, he designated the zoo and, he had rights there. The problem is they always want to say you didn't give up control. So yeah, the more things you control, the more likely it's going to fall apart. The cash value was therefore inaccessible to the owner of the company, to the DST. Satisfying part of the current access definition, benefit trust barred the company from accessing the funds for purposes other than Dr. McGowan, his beneficiary, or as a charity. The court thus concluded that Dr. McGowan had to include the full value of all economic benefits from the plan as gross income, for the tax years 2014, 2015, right? Now, the taxpayer asserted, that the split dollar regulation impermissibly, now to the company, foreclosed their deductions under 162A, because it's going to be our problem, right? IRC Section 419A generally prohibits deductions for employer contribution to welfare benefit fund unless otherwise deductible. And remember, this now is going to look at the general rule. Is there a business purpose? Is this an ordinary and necessary deduction? And remember, as the court noted, the only thing the company got from this was a tax deduction, right? That's not going to satisfy this. Deductions are a matter of legislative grace. They quote the Supreme Court on that, requiring taxpayers to clearly demonstrate their right to them. The company attempted to claim that this was an ordinary and necessary expenses paid or incurred during taxable year for carrying on the trade or business. The court found that this did not meet either the ordinary nor the trade or business requirements. It was not ordinary. The paying of premiums like this was not commonplace among dentists and dental practices, but not for trade or business. Now, that one I think is a little bit, I'm not sure how well that would stand up, but we'll go with it. If push came to shove, I'm not sure the Supreme Court would necessarily buy off, but okay, we'll accept for now. They said it's not commonplace, but not for a trade or business. Everything was, all benefits were Dr. Gowan's personal goal of leaving a substantial sum to his chosen beneficiary rather than promoting the company's profit motives. Tax avoidance alone, a tax deduction to the corporation, does not constitute a bona fide business purpose for deductibility. If it did, every tax scam would work. Or tax, well, I'm not saying it's a scam necessarily, but every super aggressive tax shelter would work just by definition. The court dismissed the two alleged business goals. Obviously, they knew this. They claimed they had them. They claimed that this was, that this death benefit was based on Mr. McGowan's, Dr. McGowan's surability and prior personal policy, not the estimated cost of finding a successor dentist. Their theory being, well, it was there to help provide for business continuity, right? The plan structure, cash value donated to charities, premiums weren't paid, would hinder and not help the company's survival if it ran into financial distress, such as, Dr. Dr. McGowan was disabled. We needed to find a new dentist. Remember, if it can't pay the premiums and it has to surrender the policy, it would go to a charity. That suggests this was not used to cover some sort of event where they needed to transfer the company on to a third party and protect the value. As sole owner, Dr. McGowan needed no incentive to remain with his own business. I mean, yeah, he's going to quit because he doesn't like the terms of his contract with the company. It's, not going to happen. He's 100% owner. So he said that is. So what the court concluded was this was an investment and estate planning vehicle for the sole benefit of Dr. McGowan, right? Not a legitimate business expense. Everything was on Dr. McGowan's benefit. And Dr. McGowan benefit is not the same as benefits to the company. So the company was prohibited from deducting any of its payments to the DBT. Right. A significant aspect of the case involved the prior Sixth Service decision. Now, this is a bit weird. The court mentions this mainly to, I think, send up a red flag that, we are probably going to reverse this if it actually becomes an issue. Now, this is a 2018 decision from the Sixth Circuit. The Matchacek case held that whenever a shareholder employee receives economic benefits in a split dollar arrangement, these benefits must be treated as distribution of property to a shareholder rather than services-based compensation. That would result in them being taxed at lower capital gain rate. In McGowan, the parties stipulated that Dr. McGowan was entitled to a $40,978.07 refund. Because remember, it's a district court case. He paid the tax, suing now for refunds. If Matchacek was not overruled because the IRS initially assessed his tax deficiency based on ordinary income tax rates. Now, the McGowan court acknowledged that Matchacek was in tension with and possibly just flat out contradicts Internal Revenue Code section 301A. When we talk about property transferred to a shareholder of the company, that would, in essence, is this really it? Is this a dividend? Is it a compensation? What is it? Now, skepticism for Matchacek exists from various sources. A, that is a case the IRS has specifically not acquiesced to. A lot of academics have criticized the decision. Legal academics have stated there are many flaws with that decision. And the tax court also said it's unable to embrace the reasoning or result of that. Tax court says, what are these guys thinking? McGowan court also noted that Loper Bright Enterprises versus Raimondo, which overruled the Chevron, remember we got rid of Chevron deference, now maintains the court exercise independent judgment in construing statutes, implying the plain meaning of 301A should overrule any contradiction in the regs. Now that's interesting because that's kind of a reverse, a Loper Bright. People don't think of it that way. It's like if you got a reg that is favorable to you, can the court reverse and say, well, even if the reg would bring it under here, the reality is the law doesn't justify that, so we're gonna say nope, not automatically a distribution of property. So, despite strong indications, there's your warning. Yeah, don't come here hoping to get that result. To the Sixth Circuit, the sun may soon set. neither party in McGowan asked the court to reconsider. Right? It wasn't raised by the IRS. So because of that, they decided they won't overturn this. They're going to defer that to another case. So he did get a partial refund despite the court otherwise affirming what the IRS said. So again, remember, the court upheld the essentially the split dollar arrangement to this structure. They got a refund only because the IRS simply didn't argue the case to overturn the precedent upon which that refund depended, right? So yeah, sort of the IRS kind of fouled up or didn't spend time on that. So, Dr. McGowan lucked out and has $40,000 more than he should, is indirectly what the court seems to be saying. Okay, next up, moving's a pain. There's lots of things. And as Donna Davis discovered, moving can become a much more expensive operation than you thought it was initially if you fail to update the IRS about your change in address. This is the case of Donna Davis versus Commissioner, Tax Court Memorandum Decision 2025-72, issued on July 10th of 2025. This case involves basically the IRS sending a 90-day letter to an address that Donna had just moved out of. Not long before. Donna had just moved, and that didn't make its way to her until a long time after the 90-day rule had expired. In fact, she actually got it by asking for a Freedom of Information request because the IRS did start pursuing her on this. What IRS notice and what disallowance and what, yeah. So we're going to talk a little bit about this. Let's talk about the case. This is Donna Davis versus Commissioner. There are strict rules for establishing jurisdiction, but they are mechanical. Okay, they're mechanical rules. You have to realize that. Outside of the Third Circuit, you're going to find these mechanical rules may result in what appears to be a very unfair denial of a taxpayer's right to go to court. In the Third Circuit, we can try to argue for equitable relief. Outside the Third Circuit, the IRS position is you can't get it, and we'll just have to see if we get actual litigation on the issue to tell us, but the tax court has stated already that they're not about to consider equitable relief unless your case goes to the Third Circuit, and Donna's case, unfortunately, doesn't go there. So it is procedural rule even when there are sympathetic circumstances. And by the way, the sympathetic circumstances also mean that's why the fact when you don't have equitable relief, the fact that you're sympathetic, and Donna's sympathetic, I mean, you see exactly why this happened to her. But Congress put bright line tests in, is the way the tax court reads this, and they didn't authorize equitable relief. So therefore, Donna's just out of luck because she didn't follow all the rules. Not because she intentionally failed to follow them, but because she, just like most people, wouldn't know about most of them. So the validity of a notice of deficiency, we call the 90-day letter, right, and the timely filing of a petition to challenge that notice. As the court will tell you every time, the United States Tax Code is a court of limited jurisdiction. It may only exercise authority that Congress explicitly granted it under Section 7442. For a case concerning a deficiency, there are various cases the court can hear. This is on a deficiency. If you have an IRS is issuing a notice of deficiency, you're going to concern a deficiency, the tax court can hear the case only after there's an issuance of a valid notice of deficiency by the IRS, Section 6212, the 90-day letter, and there is a timely filing of a petition to bring it to tax court by the taxpayer under Section 6213. Right? The burden of affirmatively showing all facts giving right of jurisdiction rests with the party invoking it. Donna has the burden of proof of showing this case, right? So she has the burden of proof of showing, in essence, and the primary issue here is timely filing a petition by the taxpayer. Presumably, if you filed a petition in court, you got a notice of deficiency. So, yeah, we're going to say it's valid for that reason. That part's probably covered. The IRS may lose the notice if the taxpayer then later says, hey, wait a minute, they're saying, wait, didn't have valid, because you know what, that notice wasn't valid. So So therefore, the court doesn't have jurisdiction and the IRS is out of time to issue a brand new one. And yes, the IRS has lost those cases. Remember, I think a week ago we discussed one of those situations. Right? So this notice was issued to Donna Davis for a 2018 tax year. Notice was mailed November 1st, 2021 to her Irvine Avenue address in Newport Beach, California. The 90-day deadline to file a tax court petition expired on January 31st of 2022. Now, her petition was received by the tax court on June the 26th of 2024. Yeah, 24, right? Bearing a postmark of June the 21st of 24. So essentially, she filed this petition 872 days beyond the deadline for filing it. Well, start out, no jurisdiction because that wouldn't be a timely filed petition. So now we have to figure out, is there a valid notice of deficiency? Because that's really the question at this point, right? If that notice of deficiency is valid, then the assessment stands and Donna's out of luck. Now, if that notice of deficiency was not valid, basically the assessment doesn't stand because the IRS never issued notice of deficiency. And because we are well past the deadline for the IRS to assess tax on our 2019 return, the IRS is just out of luck, right? They'd lose it. So now the question becomes, was there a valid notice of deficiency issued? Right. And one of the keys is that that notice of deficiency must be mailed to the taxpayer's last known address. Now, there are some exceptions if it's not, if you can demonstrate actual delivery in a timely manner that did not prejudice the taxpayer. But in this case, we're going to pretty easily demonstrate that she finally got it, yeah, as I said, under a Freedom of Information request. So, yeah, well after. Now, here's what caused some of the confusion. She used her Irvine address on her 2020 return. Her 2019 return. She filed in April of 2020. Remember, this is the COVID year, right? It was finally processed by the IRS in August of 2020. In August of 2021, she moved to Bishop, California. On October 15th of 2021, despite moving to Bishop in August, she still used the Irvine Avenue address on her 21 return, which was processed November 8th of 2021. Now, that latter one is a mistake, quite honestly, I could see being made by a tax pro who's preparing the return. The taxpayer moved. She might not have told them she had moved right away, right? She brings in her materials. She forgets to tell you she moved. You prepare the return. She doesn't pay any attention to the address on the return because she just looks for the e-file and where do I sign? Yeah, I could see how that works. So that's a danger. But in any event, she has now filed returns, 2 returns filed before the notice of deficiency was mailed out, both of which show the Irvine address. Now, that Irvine address, the second one, the return wasn't processed till November 8th, and the notice of deficiency was sent out 1 week earlier. But obviously, they didn't rely upon the 2020 return, we can say for that, but they would have received immediately been told that was the right address. So even if they rechecked it immediately, when it came back, it would have still said that's the last known address. Okay. Now, the IRS produced United States Postal Service Form 3877, proving a certified mailing of the notice on November 1st, 2021 to the Irvine address. She eventually received the notice on May 15th of 24 after she submitted a Freedom of Information Act request. A copy of what do you have on me? That's when she first saw the notice of deficiency. Nobody disputes that. Nobody claims that the one that was mailed ever caught up with Donna. Right? So, it's late. So now, of course, we have a problem. Right? Okay. Did the IRS go through the proper procedures? So now the problem is, well, the returns all said, the Irvine Avenue address. Did Donna otherwise apprise the IRS of her change of address? Now, her claim, of course, she didn't send to her last known address. She claimed that she had informed them with a couple of different methods of her address change before the notice was mailed. U.S. Postal Service change of address form. She stated she rented a U.S. Postal Service post office box in Bishop, California on June 25th of 2021 and was required to file a change of address form with the Bishop Post Office. However, she didn't have any documentation of that change of address form being filed or when it was filed, right? So that's going to be an issue. She said on multiple occasions she advised an IRS agent she had moved. However, eventually when she testified, she admitted she couldn't get through the automated system. Yeah, the IRS, it's tough to get the IRS by phone. Remember that? Yeah, that's a known thing. So she then drafted a letter on or about September 21st, explicitly stating her Bishop, California mailing address. She supplied an undated copy, but offered no proof of mailing or confirmation of receipt by the IRS. She noted it never occurred to her to send that letter by certified mail. Okay. Yeah. Remember, the proof is on her to show that this is, and her proof is now going to be on her, to show that the notice of official was not properly mailed. Remember, the IRS now has shown they have a proof of mailing. That generally is going to, if everything appears proper, that'll establish that it was mailed to the last known address, unless the taxpayer can show it wasn't. Right? And she also filed a motion requesting the court take judicial notice of the IRS delays in processing paper mail during 2020 and 2021. So her claims were that, I informed them, and is it really my fault that they just didn't get to my letters? Okay, basic rule. Notice of official is generally deemed valid if mailed to the last known address. That's under section 6212A and B. Actual receipt of the notice is immaterial if it's properly mailed to the last known address. If the Irvine Avenue address was the last known address, as defined in 6212A and B, then it doesn't matter if she ever got it. Right? I didn't get it is not a defense. Now, to prove proper mailing, so when she raised this question, now the court has to go back and ask for proper mailing. The IRS has to prove that with competent persuasive evidence. A USPS Form 3877 is considered highly probative documentary evidence of the date and fact of mailing and can establish proper mailing on its own. Okay. Now, how do we determine last known address? The last known address is generally the address on the most recently filed and properly processed federal return. Since the 2020 return was not fully processed until the end of November, remember, it had the Irvine address on it anyway, but since it wasn't processed until a week after the notice of official was issued, basically it would be the in this case, 2019 return, which also showed the Irvine Avenue address, right? This will be true unless the IRS received clear and concise notification of a different address. Now, I'll point out, that return filed that process on November 8th could have thrown a monkey wrench in the works. Had it been processed before the notice of issue was mailed, then it would have superseded her notices. So, she was just kind of lucky that one didn't get processed until later. Now, she bears the burden of proving the notice was not sent to the last known address. And the inquiry is going to be focused on information IRS possessed at the time of mailing. While the taxpayer claims was submitted that change of address form, and the IRS does check those every so often per standard procedures, the court requires documented evidence. Her testimony, no matter how believable Donna is, and the court did not indicate they didn't believe Donna, no matter how believable Donna is, her testimony is not enough to make this work without some sort of corroboration. And while she said that a post service employee would testify to that fact, she didn't submit that evidence. They never had anybody give an affidavit or a statement, give an affidavit or come in and testify in the case that was it. She filed it, that it had to be filed. So, that was kind of it. Now, the IRS had established, the initial point of proper mailing of the notes via certified mail to the Irvine address using Form 3877 from the Postal Service. Acknowledgement of the certified mailing. Now, so The IRS properly used the Irvine address from the 2019 return. That was the most recently processed return, before the notice was filed. The 2020 return, which also had Irvine address, was processed after notice was sent. So even if she'd updated to Bishop on the 2020 return, it would have been processed too late, but she didn't, which doesn't help her case, right? In essence, that still showed Irvine. The IRS records show no change to the Bishop address until 2022, which means that, that change was later and after, basically after the properly mailed notice had gone out. So that was, and that's most likely how they eventually got notices to her asking for money, right? After they started sending dunning notices again after COVID. And that's most likely how all of this came to be known. So yes, it is a COVID got in the middle of this too, right? Now the court looked at her notification attempts, because remember, this is the only way she gets out of this now. I notified the IRS clearly of my new address. The change of address form, no documentation, no corroborating testimony. So not even a need to try to figure out if it was done early enough for the IRS to have had that, right? And it's also kind of interesting, of course, that, nothing ever got forwarded, apparently. Telephone calls the IRS. She herself testified she couldn't get through on the phone. That's trying to call the IRS is not the same as actually telling them your address changed. Trying to call them, tell them your address change is not the same. By the time she testified at trial, she never showed any successful communication with an IRS personnel to inform them of her new address. Okay. The court found her copy of an undated, her copy of the letter was undated, so it didn't even provide a date she put on for when she wrote it, and noted the address, the absence of any proof of mailing or IRS receipt, and said, it was therefore unlikely the IRS received this letter before the notice was mailed, and they have to have received it. The court found the petition was filed on June 26, 2024, more than 2 years after the January 31st, 2022 deadline. It is it's untimely. Without a timely petition, the tax court lacks jurisdiction to redetermine liability. Therefore, Donna, you owe the tax. You can pay the tax, and if the statute's not run out, we shouldn't have by this. It's still so you can pay the deficiency and then sue for a refund, and go through that route. But you're going to have to pay the deficiency, and you're going to have to go to district court or court of claims. Now, the court denied the taxpayer's motion to take judicial notice of the IRS mail delays. Said there was no evidence of any change of address correspondence to the IRS before notice of mailing, so those wouldn't have impacted. And while the court was sympathetic, understood exactly, said, yeah, we understand. Yes, we are definitely not saying you didn't send address changes to the IRS. We're not saying you didn't file with the USPS. Our problem is you can't document it. And Congress has granted no authority to provide a remedy under these circumstances, regardless of the taxpayer's inadvertence. In fact, she just didn't know better, and there's no reason she should have known better, or their attempts. We can't do it. Again, in the Third Circuit, you might get a different answer, but not here. So taxpayers who miss a deadline may need to explore other avenues. That's paying the tax and suing for a refund. And that's not a good alternative. In most cases, the math just doesn't work, right? So again, remember, jurisdiction is key. The 90-day deadline is crucial. The tax court outside the Third Circuit takes the position it cannot waive or extend the jurisdictional deadline. It can't consider equitable reasons for doing so, right? It's strictly enforced. Missing this deadline almost always kills your tax court case. There are some limited exceptions in the law, and in the Third Circuit, you might have a chance of arguing equitable relief, but who knows? And the last known address really matters. This is the key mistake she made. There are ways to officially notify the IRS of the address. She should have filed the forms 8822, if I remember my forms right, with the IRS and sent it via certified mail, and probably return receipt, because again, there's a presumption of receipt, but again, because the rule is, did they receive it in time to update the records? What did they know when they issued it? You really probably would like to have that, with the records. You go online and get the records of when the Postal Service recorded delivering it to the IRS. Note those things, but we really need that. And the last known address matters. The IRS is generally entitled to rely on the address from the most recently filed and processed federal tax return. Right? For the address to be effective, the IRS must receive clear and concise notification, and you need to document the fact that you have sent that and document every way. And if you do a change of address form with the Postal Service, again, that's a little tougher to show what time, how long it should be there. But if it's there long enough, the court probably agree that it should have been, the IRS would have picked that up. Make sure you document that, right? Critical importance of documenting that you notify the IRS timely of address changes, right? And through documented communications channels. Certified mail, official IRS channels with proof of relief, oral, uncorroborated testimony of oral or unproven written notification is generally not going to work. Yeah, this is unfair, but it's kind of the way it worked. And you thought we were done with new tax laws. Well, we're not. Rather, we now have another new tax law, right? We have the Filing Relief for Natural Disasters Act. This was passed by the Senate by unanimous consent on July 10th of 2025. And it will make changes to the automatic extension rules, the ability to give filing date relief under Section 7805 Cap A. It does two things, and we'll talk about the things it does. One of the key things it does is it allows the relief to be triggered by a state designated disaster, right? So basically the governor of a state, subject to rules and regulations that the IRS will come up with, can designate a disaster even if the feds have not designated it. So if there is some disaster that so basically your city, your state, I shouldn't say the state has designated except in DC where the mayor can. Designates a disaster that can qualify for extended filing deadlines. You do not need to have a disaster that is of such a magnitude that it will make the federal disaster list. So your governor has a right to do something. So let's talk about what we have here, right? Again, now understand, while it passed the House and Senate, it has not yet been signed into law by the president. Bills tend to wait a while to get signed by the president. He has 10 days to do so. And unlike the One Big Beautiful Bill Act, he didn't wait on that one because he wanted to sign it on July 4th. Let's understand that there is, certain, value, PR, political communication value in doing it on July 4th. So, this one's not quite going to be the same impact. So while it's really important to a lot of people, potentially, it's just not something that, probably is going to be rushed to sign. It'll go through probably, and unlike the One Big Beautiful Bill Act, where, July 4th meant they rushed and they probably didn't vet it totally, but I suspect it was vetted based on the original Senate proposal. And we'd kind of known what that was. It took the House a few days to go through it. So I think there was vetting going on before it passed the House to make sure there was no bomb in there that they didn't want to sign. They would be like, no, don't sign this. But basically this one's going through vetting probably now to make sure there's no unexpected effect of the wording, right? It does expand the scope and duration of relief provided under 7508 Cap A. This is what allows for a delayed filing deadline, right? We kind of saw that to a certain extent in COVID. There's some back and forth about how that worked, but we can get there. So currently Section 7508 Cap A grants the IRS broad authority to postpone certain tax-related deadlines. The IRS can specify a period of up to 1 year that may be disregarded when determining tax liabilities for affected taxpayers. And this will impact whether not only filing, but a bunch of other acts are performed on time, like they generally kicks back the date for having to put your money into an IRA after the end of the year end. It kicks back other things that are tied to due dates, so you can fund your plans a little bit later. Various other things can be done based on the kickback due date, right? And it also impacts the amounts of interest and penalties and the amounts of any credit or refund, were things received on time, right? Now, to trigger a relief, you need a federally declared disaster as defined in Section 165 I-5 Cap A. It was updated in 2008, 2018, right? There must be, if there is a significant fire, that was added in 2021, where assistance is provided under Title 42 of the United States Code, Section 5187, or if there is a terroristic or military action, excuse me, as defined in IRC Section 692C2. Now, the IRS, the IRS, basically, the Treasury Secretary of the IRS, may also specify a period of up to 1 year for these plans to disregard deadlines for required permitted action, ensuring they're not treated as failing to operate solely due to this disregard. So it can separately grant relief for benefit plans. Right? And in addition to the discretionary authority of the IRS to make this extension, Section 7508A also provides for a mandatory 60-day extension for qualified taxpayers. This begins on the earliest incident date specified in disaster declaration and ends 60 days after later of that earliest incident date or the date the declaration was issued. This period is disregarded for specific acts related to tax liability. So it's a lesser but kicks in right away level if we have a disaster declaration. Okay. Now, it applies to qualified taxpayers, right? So this is an individual whose principal residence located in a disaster area. An individual whose principal place of business, excluding employee services, is in a disaster area. Relief workers affiliated with recognized organizations that assist in that disaster area. Taxpayers whose records for meeting a deadline are maintained in a disaster area. Individuals visiting a disaster area who were killed or injured, and spouses on a joint return where the individual is one of the above. So they'll qualify even if the spouse would not meet the requirements. As long as the party you're married to does, married filing joint return, you'll get all the relief. A disaster area, if for this mandatory 60-day extension, means when an area where a major disaster for which the president provides financial assistance occurs. Okay. And also it does extend some plan-related actions, pension plan-related actions. This mandatory period is in addition to or concurrent with any discretionary period specified by the Treasury of the Secretary. And a real-world application, this is a little bit disputed about whether these triggered then or not, but at least 7508 principles were used to defer payroll obligations. There's an executive order which may or may not have relied upon this, but basically the concept was no question, it was based on the same concept of kicking them back. So what does this new bill, assuming the president signs into law, what will the Filing Relief for Natural Disasters Act do? What will it change? So let's start with the first one. We're going to have new authority for a state-declared disaster. This is probably going to make the biggest change. We'll talk about the second one, but the second one usually is rendered irrelevant. But, in essence, what they're going to do there probably won't apply in most cases because something else will step in ahead of it. But still, we'll do that. We'll deal with that one later. They did add it, right? So it's a crucial part for current requirement for a federal declaration or a specified significant fire. The IRS may, after consultation with the administrator of the Federal Emergency Management Agency, may apply existing tax relief rules to a qualified state-declared disaster. Right? So, what the IRS can do. The application would require a written request from the governor of a state or the mayor in the case of the District of Columbia. So your governor would ask for relief. They could ask for it, they're going to ask for it protectively before the president does. Because remember, the president's declaration is based on other rules, and there's a lot of other things triggered. The state can simply ask for a state disaster declaration to work for this point. Now, to be a qualified state disaster, it must be a natural catastrophe, hurricanes, tornadoes, earthquakes, snowstorms, and droughts, or regardless of cause, any fire, flood, or explosion. Right? Something blows up, right? There's a fire, there's a flood. Even if it's not a natural disaster, it was, man-caused due to negligence or whatever, but your house gets flooded because there is some sort of big pond being maintained by a business that didn't maintain the dam correctly, where they're putting their wastewater and stuff, and it floods you. That, in theory, if it was big enough, could trigger this right there. The key condition that the mayor or governor determines the events cause damage of significant severity, and magnitude to warrant the application of these delayed return filing rules. And state means the states, obviously, the 50 states, but it also includes the District of Columbia, Puerto Rico, U.S. Virgin Islands, Guam, American Samoa, and the Commonwealth of the Northern Mariana Islands. If enacted, this would be redesignated as subsection C, with the current subsections renumbered following it. Okay. Again, remember, we expect to be signed into law, but we'll have to see. The second significant change would relate to mandatory extension period. This would amend the redesignated subsection E, currently D, to change the mandatory 60-day extension to 120 days. This means the period beginning on the earliest incident date would end 120 days after the later incident date or the declaration issuance date. And multiple declaration rules, which currently applies if declarations are issued within a 60-day period, would similarly be adjusted to 120-day period. So yeah, we're getting a double period. Now, as I said, generally this probably won't matter because we will have the Treasury grant relief on all these issues on their own well before the 60-day or 120-day period ends. But just in case they don't get to it by the end of the 60th day, you now have 120 days. So you're going to have time period to plan for at least up to 120 days automatically. So basically, you're going to now have 4 months instead of 6 months of a delay. Right? The heading of the subsection is changed to reflect it's 120, not 60, and basically just doubles the automatic relief period, right? And that plays for taxpayers and pension plans. So again, it's really a buffer for awaiting IRS to act generally. You're going to have a 128-day period if this is signed into law. Now, the big thing for us to remember about this is the fact it could now be a state-declared disaster is significant. It also means, you may want to make sure that your state organization, whatever it is, has been in communication with the governor's office of your state. Once it's signed into law, to point this out, and certainly get involved early on if there is a disaster, contacting the governor's office to say, we think you probably should consider requesting this relief. You don't need to wait for the president to do something. You can go ahead and just request right now and get the granted based on your state declaration, and not have to wait for the feds and get the relief. Now remember, this is not the automatic relief because, the FEMA and the IRS have to approve the request that it meets the requirements. So it's really going to be under the standard rules, not the 120-day rules. But conceivably, it definitely gives you a buffer during that 60 or 120-day period, potentially, until the IRS acts. If there's a federal declaration, well, we've had the federal. It gives you, though, some time to work with. It starts building, some relief in already. So you got to monitor state-level disaster declarations, gubernatorial requests for IRS relief, in addition to the federal declarations. So be aware of that, right? And as I say, it means, when there's a disaster, something you think should have disaster declaration, not only do you call your senator and congressman to lobby to get them to lobby the president to declare disaster, but you also now want to tell the governor, A, help lobby the president, but B, make your own request to the IRS, to get that rolling in this issue. And again, the automatic relief, that's, as I said, mainly gives us a buffer in case the IRS gets backed up in issuing these. So we're there for that purpose, right? Again, you got to remain diligent to the specific definition of qualified state disaster and the procedures. The mere fact the governor said something bad's not good enough. The governor sends a written request. There has to be a consultation with FEMA and approval of the request for setting that thing. And then the Treasury, actually setting the time periods. So remember, the steps have to be involved if you go down this route. The amendments proposed by this bill would apply to declarations made after date of enactment, which is the day the president signs the bill. And I don't believe yet it has been signed. It had the last time I checked. Again, it's already passed out of representatives, so you should stay informed about its progress through the legislative process and be prepared for potential and impactful changes to disaster tax relief that your client should be aware of. This has been the Current Federal Tax Developments for the week of July the 14th, 2025. Again, you can email me, edzollers@currentfederaltaxdevelopments.com if you have a quick question. I also tend to look in on the Connect sites run by Arizona, New Jersey, Illinois, Idaho, Washington, those involved in that. I think I did everybody in there. Yeah, I think I did in that mix. We obviously will be checking back with you next week. I am continuing to do sessions on the the full-blown bill, which, as I said, takes quite a bit going on. I've got sessions this week in Arizona. I'll be doing a couple of sessions next week for Minnesota and Idaho. And again, they're doing 2 and 4 hour versions. I think in another Arizona run of the 4 hour version, if I remember right. And I think there is a replay of New Jersey's 3 hour version I did this past week coming up this week. So we got a bunch of them hanging around, and we will have a full 4 hour version for Minnesota in August. So that's kind of where everything sits. So if you're looking for that whole big bill, big, beautiful bill stuff in all its gory details, we have those. But anyway, I will see you guys next week. Hopefully, we'll talk about whatever happens in the coming weeks in taxes. And so I should just close with go ahead and come back here next week for more discussions of current federal tax developments.